Ladies and gentlemen, let's begin with the unavoidable truth. Soft debasement of the US dollar is no longer a theoretical discussion. It is a mathematical certainty. The Federal Reserve will be forced to monetize government debt to avoid a sovereign default. This is not an accident. It is policy by design. The price of avoiding default is the destruction of purchasing power. The probability of a liquidity event is effectively certain. The only unknown now is timing. By early 2026, interest payments on roughly $38 trillion of national debt will eclipse the entire U.S. defense budget. That is fiscal singularity. Tax revenues cannot bridge this gap without crushing the economy, which means only one institution remains capable of filling the hole: the Federal Reserve. It will become the permanent buyer of last resort, and that institutionalizes debasement. We are transitioning out of the oceanic era, the era defined by naval dominance and dollar financial empire, and into a continental era dominated by hard assets, industrial capacity, and land-based trade networks. Just as the UK's credibility collapsed during the 1956 Suez Crisis, the US risks a similar confidence event. Once credibility unwinds, it does not return. Trade routes, capital flows, and geopolitical allegiance will follow hard reality, not nostalgia. Here is the event horizon. The end of January 2026 becomes the budget showdown. When the one big beautiful bill expires, Washington confronts a fiscal cliff with no political pathway to resolution. Foreign creditors are unlikely to roll debt at prevailing rates. That forces a treasury market freeze, and it leaves the Federal Reserve with one option: flood the system with emergency liquidity. This is the official ignition point of soft debasement. A structural fracture has already begun. The price you see quoted on COMEX is no longer the price required to secure real bullion. Western vaults are bleeding metal to Asia. Claims are increasingly not being redeemed in physical settlement. When financial markets lose faith in settlement, derivative pricing ceases to matter. The only price that matters is the price at which you can actually take delivery. Silver is no longer merely a monetary metal. It is an industrial lifeline. Solar technology, electric vehicles, advanced semiconductors all depend on it. And for the fifth consecutive year, demand eclipses supply. There is no surplus. When scarcity collides with strategic necessity, pricing stops being speculative and becomes existential. Silver becomes the choke point of the green transition. Global investor psychology has changed forever. We are past the era of chasing yield. We are now in the era of survival. Capital is no longer asking, "How much can I make?" Capital is asking, "Will I get my money back?" As private and sovereign investors exit debt markets, central banks are forced to step in. That forced liquidity is precisely what guarantees currency debasement. Now layer geopolitics onto this already fragile structure. The Caribbean standoff is not just a regional confrontation. It is a live-fire stress test of American power. Naval doctrine is being applied to a geopolitical reality that is increasingly continental in nature, and it isn't working. The greatest risk is not military defeat. The greatest risk is oil price shock. And oil shocks are inflation accelerants at the exact moment the Fed is forced to loosen. There is a tail risk scenario we must acknowledge. If soft debasement is insufficient, the United States could reprice gold to roughly $20,000 per ounce. That instantly reduces outstanding debt in real terms, at the cost of a global monetary rupture. Fiat currencies would lose 15 to 20% of value overnight. This probability is under 10%, but it exists. And because it exists, sophisticated capital plans for it. Once liquidity is injected, February 2026 does not begin with collapse. It begins with a melt-up. Stocks rise, real estate rises, nominal wealth increases. The system feels like it revived. But this is deceptive. Purchasing power collapses even as assets inflate. And then there is Australia. It will experience a commodity revenue boom in dollar terms, while its currency is violently whipsawed between two worlds: US alignment and an Asian-centric commodity future. Think of the US economy as a steam engine running out of fuel. To keep it moving, the engineer has started ripping apart the train itself and burning the train cars to keep the engine alive. Yes, the train is still moving. The speedometer may even rise, but it is consuming itself to survive. The Suez Moment is simple. It is the moment passengers finally realize the train is on fire.